podcast interview with myself, Lisa Chinati, and Tom Toole. I encourage you to go check it out. We asked a whole bunch of interesting questions that Damien had to react to that he's actually never been asked in the past. So go check out the Realtor.com CEO interview over on at Knowledge Brokers podcast. That is, I think Bobby will link it up if you missed that last week. All right. I see the comments coming in. I don't know if Bobby, did we have a technical difficulty there? Because my screen just said we went live late here. So anyways, looks like we're good to go. Let's jump into it as we do every single Monday. I'm going to take a look at inventory. Last week, we had a disappointing inventory week, but the good news is we got it all back this week. So we're looking back on track as it relates to the weekly housing inventory update. Last week was a miss after 2 weeks of really good inventory reads. Again, we're looking for anywhere closer to 15,000 plus per week to get us back to a more normal rate of inventory growth. Weekly inventory change from last week was up just at that number, just about 10,000 anyways, from May 3rd to May the 10th. Same week last year, we saw just a 1,000 active inventory increase. This is Altos Research. Comes out with this every single week. So a lot higher than last year. And also the big number that I'm impressed with is the 568,000 plus that we're at right now is really the peak of where we were last year. So here's the mark from last year, 35% from this time last year on active inventory across the country, 35% more active inventory right now versus the same time last year. In fact, it took us all the way until November to reach this level of inventory in 2023, and about the same time, a little bit earlier in the season in 2022. We haven't reached these two levels until the very end of the year, when all those homes that didn't sell in the summer and early fall are still on the market before they start coming off ahead of the holidays. We're already at that level. You could certainly argue that in maybe just the next 3 weeks, we'll be up above 600,000 active single-family inventory. This is obviously well off of the levels that we were at back in 2017, 18, and 19, which is a more normal market. You can see June of 2017, for example, came in at 973,000. If we take a look, I like looking at 2019. If we look at the same time frame, 2019, in May, we were at about 915,000 on active inventory. So we're well off of those marks, but we're 35% better than last year. So we're certainly coming off of the bottom as it relates to active inventory. New listing data. Another pretty good week. We've had strong weeks. When we compare to last year, we were at the all-time low, 68,000 plus, almost 69,000 last week for new listing data, almost in line with 2022, well above last year. And we expect to be above last year on every weekly marker, which we have been throughout the year so far this year. So new listing data comes in right where we want it. And price cut percentages come in at 33.7%, which is very normal. Don't see that it's higher than last year and the year before and consider that a bad thing. A third of homes in a normal market will have a price reduction before they actually sell. So 33.7% is where we came in last week. The same week last year coming in at about 30%. And of course, 2022 was such an anomaly of a market. Those numbers were way down before the rates started to really ratchet up. So normal level for price cuts. This is just going to take a different type of skill than the agent the last few years when talking to homeowners. Okay. People that are thinking about selling are going to have to expect that there's a little bit more time on the market. There's 35% more inventory. Okay. There's 35% more inventory, and we're not trending to have more sales. We're still trending around that 4 million mark for sales. One of the reasons that we're still getting obviously some sales when you consider how high the interest rate is is because people have to move, but also this spread between the 30-year mortgage rate and the 10-year treasury yield is finally starting to improve. Okay. If you look at where we were last year on the spread was close to 3% difference between the 10-year and the 30-year. Now we've dipped same time here. We've dipped, we were at 2.89 last May. Now we're at 2.6. So that spread is starting to improve, maybe even ahead of schedule. Okay, if you go back, what was the spread back when January 2022 when rates were really low? The spread was 1.5. Okay. Historically, the spread gets to two or maybe just under two, like 1.8, 1.7. So we still got a long way to go to the spread. Improves. That spread means that the 10-year could be where it is today, and the 30-year would be lower, be maybe already in the mid sixes if we had a more normal spread. Okay, it'd be in the mid sixes because we're at 4.5, give or take, on the 10-year. We'll take a look at the updated 10-year here as we sign off for the show, as we always do. But as that spread improves, the 30-year improves without anything else happening. There's been some discussion that the spread really won't improve until labor breaks and the Fed starts to make their move with their cuts. But it's been improving ahead of schedule, which is a good sign, because when we don't expect that to be next meeting or anything, but when the Fed does decide to cut, if this spread continues to improve, you could have a double whammy effect where you've got a 30-year fix that can get lower faster once they do start to cut. All right. Now let's just be real. We don't expect that to be happening anytime soon. Mortgage purchase application index applications continue to be lower than at any point last year, as well as obviously 2022. Still have a significant sector of cash buyers out there. But this is the reality of where the market is. The unaffordability of the market is starting to wear to some degree on the U.S. consumer. And we see the U.S. economy showing signs of not a cliff, nothing tragic here, but of loosening up. We see the job market definitely loosening up. We went over that last week. All right. Adam is reporting on homeowner equity. Here's maybe another early sign that the that the top is behind us. Okay, equity trends in Q1 2024, 45.8% of mortgaged residential properties were considered equity rich. 45.8% were considered equity rich, which is a slight decline, not a big decline, a very small decline from 46.1% in Q4 2023. The percentage of homes considered equity rich decreased in 26 out of 50 states, quarter over quarter, often less than 2 percentage points. Underwater mortgages, the proportion of seriously underwater mortgages increased from 2.6% to 2.7% quarter over quarter. I mean, if we get to 3%, not a big deal. We get slightly over 3%. Underwater mortgages, not a big deal. Okay, those of us that actually remember 2008 that were either carrying mortgage or working with people during that time, remember how high that number got. We're nowhere even close to that number. So when you see the headlines this week that underwater mortgages are on the rise, remember they're bouncing off of an absolute all-time bottom, and an increase from 2.6 to 2.7% quarter over quarter is not anything to be worried about. It is a sign that the economy is starting to move maybe towards the other direction a little bit. Okay. Increases were noted in 37 states, mostly by less than 1 percentage point, with the South experiencing the largest rises. Okay. So as the South is seeing a rise in underwater mortgages, what's that related to? It's related to that increase, obviously, in inventory, which can have a downward pressure in some areas on prices when you have these numbers go up. Rob Barber, the CEO for Adam, can find this obviously in your hot sheet show notes inside of BAMX, says homeowner balance sheets continue to benefit in a huge way from the boom times in the form of elevated equity that can be used to help finance all kinds of things from home renovations, business startups. Still, the windfalls are starting to erode bit by bit amid mounting signs that the market is no longer so superheated. I think that's the thing. This is not a superheated market anymore. and we expect some of these things to happen as it normalizes out. Regional equity distribution. The highest levels of equity rich properties were in Burlington, Vermont, 88.6% equity rich. Benzie County, Addison County. Man, Vermont's on the list. Three of the top five. Washington County in Vermont, and then Manistee County in Michigan. So Michigan's got two, and Vermont has three. Interesting. Counties with populations of at least 500,000 and the highest equity rich would be Santa Clara, San Jose areas, San Mateo County, California, Orange County, California, Palm Beach, Florida, and Miami-Dade, Florida. So where you've got larger populations and the most equity rich, there you go. You get California 3 times and Florida. Lowest levels of equity rich properties would be Campbell County, Wyoming, Vernon Parish, Louisiana, just outside Baton Rouge. We know Louisiana's been hit here quite a bit. The last year we've been looking at that. Jefferson County, Marshall County, Pennsylvania, and then over 500,000 with the smallest equity. Baltimore, Prince George County, just outside DC, Cook County, which is Chicago area, Jefferson County in Louisville, and Annapolis, Maryland. Okay, there you go. The portion of mortgage homes considered seriously underwater had that slight increase. Nothing to worry about there. Ignore those headlines. Remind them that what 2008 looked like versus today. All right, we got a report here, and we've got this article available over on nowbam.com. This is a report from 2 different sources. Clever Real Estate teamed up with Rabbu.com, R-A-B-B-U, to identify the 10 best and worst short-term rental markets for investors in 2024. Okay. Airbnb surprisingly started 17 years ago. Since that time, there has been over $250 billion made for 5 million Airbnb hosts from about 1.5 billion stays. So Airbnb has been very popular. People thought that Uber wouldn't take over taxis. They did. People thought that nobody would want to stay in somebody else's home. They'd always prefer a hotel, but that wasn't the case. $250 billion later and 17 years later, Airbnb has obviously been a massive success for the Airbnb company. I think there have been some folks who have had a tough time being an Airbnb investor. It's a sexy thing. A lot of people say, well, I want to get into real estate. I want to do Airbnb rentals. Well, tell me why you want to do that over an annual renter, one tenant, for the whole year. And you want to have all these people coming in and out of the home. Tell me why. Well, I can make more money. In some markets, that's an illusion, making more money. I've advised against Airbnb for many people who don't know what they're getting into. I hear a lot of inexperienced Airbnb owners. It's not going to be that hard. Just go in there. Somebody's going to clean it. I'm going to get a cleaner. I'm going to get somebody to do this. I'm going to get somebody to do that. Before you know it, all your return is going to all those somebody's doing something for the property. In the right market, with the right operator, can certainly be a great deal. But for whatever reason, it became the sexy investment. I don't find it to be that sexy. I find it a great way to create a lot of wear and tear on your property unnecessarily, and a great way to obviously have your head spinning every single week with all the coordination that goes into it. Some people have great systems. It's easier than the way I just described. But for most, it's been a headache. Okay. But there's a lot of other things that are up against Airbnb. Some of the municipalities, cities are changing those laws over the last 17 years. Okay. During this study, though, they identified what could be the best in short-term rental markets, and here's how they did it. Okay, to identify these markets in 2024, they analyzed 50 of the biggest metro areas, and they ranked them according to this. Median home price, okay? Return on investment score. That had 4X, both of those categories. 3X would be occupancy rate, average annual revenue for property owners, property value change in the past 5 years. I don't know what the to me, I don't know what the property value has to do. If I'm buying an Airbnb, it's like median home sale price and property value. I don't know. It should be more about the return, the annual revenue, these types of things. But anyways, that would be me. I guess you want to care about the property in case you got to turn around and sell it, but then it's like, what, you know, then it really means the investment didn't work out the way you envisioned it. Google search volume for terms related to short-term rentals. That makes sense. That could be maybe even higher to me. Percentage of listings suitable for Airbnb. Zillow current property values is down there, and the number of total listings. So this is what they used to identify these. And let's take a look. Tampa emerged as the top 10, number one short-term rental market for 2024. Orlando and Jacksonville make out the top three. So you got Florida, Florida, Florida. Then you've got Boston, Miami, Buffalo, Columbus, Ohio, Chicago, Providence, and Kansas City. There's your top 10. Okay. Tampa to me is a little bit surprising. Based on the results, Tampa emerges the number one short-term rental market in the U.S. for 2024. Number of property listings there is 16,000, which is triple the median. So there's a lot of competition there. The Airbnb occupancy rate. So here's the other thing. What this list considers the best short-term rental market. The Airbnb occupancy rate in Tampa is 44.8%. So less than half the time do you have somebody paying you money. Okay. Average annual Airbnb revenue is $52,705. Okay. Certainly now Airbnbs don't look attractive. If some of these homes are going to have a $3,500, $4,000, you put a $4,000 mortgage on some of these properties in Tampa and your average annual Airbnb revenue is $52,000. Well, before anything goes wrong, $52,000 minus $48,000 to pay the mortgage before you got to clean the place and all this stuff. You're underwater on your ROI on Airbnb. Just the Airbnb is too volatile of a market for me to ever like, but that's me. You may disagree. Go ahead and feel free to disagree in the comments. The 10 worst short-term rental markets would be San Jose, Birmingham, Alabama. I mean, Birmingham, Alabama, probably the only time anybody's going to really need an Airbnb is college football season, right? San Antonio. Yet San Antonio has a lot of Airbnbs. Houston, Sacramento, Raleigh, Riverside, San Francisco, Oklahoma City, and Pittsburgh are the 10 worst short-term rental markets. I think one of the eye-opening stats here too is what somebody should expect. If you're advising somebody, well, how often should I expect to have this occupied? I mean, look at the top 10. You've got 45%, 46%, 44%. Boston's at 49%. Miami's at 41%. Buffalo's at 40%. Columbus is at 41%. Chicago's at 43%. Providence is at 45%. And Kansas City's at 44%. That was the top 10 best short-term rental markets, and all the occupancy rates are down under 50%. Cleveland, which is the 15th best market, is 38% occupancy. Virginia Beach, which this makes a lot of sense to me, which is the 18th best short-term rental market, is only 36% occupied. Who'd want to be in Virginia Beach in January unless you live there? Denver's at 50%. That's the highest I think I've seen on this list. Dallas is at 39% occupancy rate. Okay, you've got nothing substantially over 50%. It's very hard. It's basically impossible in the top 50 largest metros to get over 50% on occupancy rate in short-term markets, these short-term rental markets. Okay. Now somebody could argue that, well, that's actually going to keep the wear and tear down. No, it's not, because if somebody's living in your house for a whole year, as opposed to people that are coming there for 50% of the time, but that are only there for 3 days, who are treating it like a hotel room. If I'm there all year, I'm treating it like home. It's home to me. I'm not just walking in and, dumping a 30-pack in the sink and pouring ice over it and going wild, right? It's home when I'm there all year. When I'm there for 3 nights, 4 nights, 5 nights, that people are treating it as such. And that creates that tear, that grind on the property. All that information will be linked up for you. We got a bunch of information on this report. If you're in a short-term rental market, I'd encourage you to jump into the show notes today on BAMX and grab that to help advise your clients. BAMX, of course, you can use code 10% to get use code BAM rather to get 10% off of that. All right. Let's move into 10-year. I did see what was the question there about I saw a question. What's my opinion on rental arbitrage? I'd almost wish Therese could get on and say what specifically. Go ahead and ask me what specifically. I'm assuming you're talking like people that are trying to take one rent and then rent it to other folks. Trying to play the anything short-term rentals. I'm not a big fan of. Okay, not from an investor perspective. All right, let's take a look at the 10-year. And if you want to go further in on that, I'm happy to answer my opinion on that if I've got any data. 4.473 coming in here on the 10-year. 4.473 is where we're at. If we take a look, zoom out here for the 1 month. Here so far in May, we're starting to see a little bit of an improvement. Okay, I think that's in relation to the labor market softening. Okay, 30-year fixed last week ended at 7.16. 7.15 was Thursday. The Freddie Mac 30-year fixed weekly came in at 7.09. So that's where we're heading into this week. Right now, we've got stock market, S&P, NASDAQ all up here as we start this week. So we'll take that. All right. I don't know if Latrice had anything more on that. I think what she's talking about is folks that are renting to then sublease. I think it's stupid I think renting a property then sublease, and it sounds like some type of scheme crypto bros would come up with. I don't know. If you want to get into the rental market, go figure out how to buy property. Figure out what your niche is. Is it renting long term? Is it the short term? I'm very cautious about advising investors into short term that are new investors. I always think it's better to go rent something for a year, get the feel for it, figure out how much more money can you make doing the short term than the annual in that market. That's a number you got to know. But yeah, it doesn't sound like she's going to further follow up there. All right. A lot of people do rental arbitrage. I'll dig deeper into that. I'm happy to comment on it. I guess I'll dig a little bit deeper into that and comment on it for sure. This Wednesday, we've got a webinar, free webinar with BAM. I don't know if we could put up a link here, Bobby. Myself and Brian Boero from 1000 Watt are going to be going into branding during this change. There's a unique opportunity here the next 90 days to lean into what you need to do for your brand. This is a great opportunity to jump in before the Brand and Marketing Summit that 1000 Watts hosting in June in Dallas and learn directly from Brian. They've helped so many of the biggest brands in real estate come up with their brand identity, the next steps that they should move forward. And we're going to have a discussion about why right now is the biggest opportunity we all have in brand in our careers. We're going to have that discussion on Wednesday, 3:00 Eastern. So make sure you hit the link. Join us for that free webinar on Wednesday. Myself, Brian Boero from 1000 Watt. All right. That's the start here for the week. I will see you guys back here tomorrow, 9:30 on the East, 6:30 on the West. Until then, toodaloo.